Hello and welcome to Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Flux Institute.
I'm James Todd, Trader Performance Manager here at Onyx Commodities.
And I'm Spyridon Kokas, Oil Research Analyst here at Flux.
Plenty to talk about this week. First, we'll discuss the US regional banks and their losses are in focus. Chinese fixed asset investment falls. That data came out this morning, first time since 2020. French credit ratings being cut to A+. Precious metal volatility is suddenly spiking, which makes trend following that much harder. And bond yields are now trending lower. We'll discuss if that's starting to predict a recession. So if we go straight on to the regional banks, the US regional banks, huge losses at Zions and Western Alliance. Though having said that, those losses pale into insignificance compared to the recent collapse of First Brands and Tricolor. But if we look at the 2-year chart here, you can see the impact it's had. Yields here are on the lows at 3.45%. If this breaks lower, we'll see more buying of bonds and the market will be pricing more rate cuts. Now, the OAS is already pricing 116 basis points of rate cuts. So if the market's going to start pricing more aggressive Fed cuts, then the market thinks there's a recession coming.
Yeah, I think what we're seeing in banks, regional banks in the US, obviously that headline has been pretty worrying there. But you've also got to look further afield. And I start to wonder, are we going to be seeing, some pretty significant banks really start to wobble a bit? I think Friday was a particularly bad day for European banks. And there's been a headline over the weekend as well about BNP. They're going to be potentially suffering a class action lawsuit that if they were to lose, that they might have about 20,000 claimants against them. Of the 3 claimants that have been successful, they've paid $20 million. If that were to be replicated across the entire class, you'd be seeing basically the entire net value of BNP, up for grabs due to their involvement in the situation in Sudan. So we're seeing the balance sheets of banks across the world are going to be really, really scrutinized over the next 6-12 months, and in an environment that they've ultimately had quite a good 12 months leading up to this. But yeah, as we see things start to teeter, I'm sort of looking at this and pretty worried about the health of the banking sector.
Yeah, there are some risks, but the question is whether this will be a systemic risk across, many regional US banks to start with. So far, it's only the small players, especially these 2 banks that were the headlines that came on Thursday. It doesn't feel like other big banks like the likes of JP Morgan would be as impacted, but as Jamie Dimon said, that came on I think Thursday night, highlighting that. But we need to see how this is going to play.
And one thing I'd say on that is the financial crisis didn't feel bad when it started, but it takes weeks and months to play out. And I'm not saying this is a financial crisis, but these things start slowly and they take a long time to play out. An interesting point with that chart is, of course, you can see the trend line above. We may be getting CPI in the US coming out on this Friday. If inflation is a concern and the Fed won't be cutting as aggressively, then the chance yields go back higher. But at the moment, the market seems to want to buy bonds and push yields lower. Yeah. If we move on to this morning's Chinese data, data came out slightly weaker than expected. GDP growth eased to 4.8%. That's the lowest pace in a year. Exports were strong, but of course the exports are not going to the US. They're going, I guess, mainly to Europe, which is going to have a deflationary impact there. Household consumption slowed. Fixed investment fell for the first time since 2020. And you can see here as well, China's house prices fell more sharply than expected. They were down 0.3% on the month. Sorry, 0.4% on the month, down 0.3% the previous month. Steepest decline in 11 months. And if you can see there, they've been going downwards pretty much since the third quarter of 2021.
Yeah, China is a really interesting case. We have big economies. They project, GDP growth around 2% or even lower for this year. And then you have China around 5% GDP growth expected. Obviously, this is heavily relied on exports and basically stimulus from the economy. As we saw that the Chinese government reported their budget deficit increased to over almost 8.9 trillion yuan, which is about $1.25 trillion. So this is a lot of money. China seems to continue use this policy and have their government on life support basically right now. As you clearly mentioned, James, house prices are down. Demand remains relatively weak, the domestic demand. They just rely on exports right now.
But combined US and China GDP is nearly 40% of global GDP. This is pretty weak data we're seeing.
Yeah, definitely. We need to see how this plays out, but China being China, we still need to figure out what's next coming in. They're still in deflation. PPI runs for 3 consecutive years in deflation, and consumers seem relatively weak, I would say.
If we move on to France, S&P downgraded France from AA- to A+. France, people aren't going to be buying the debt. There's a loss of confidence there. You can see here the spread, French bonds to German bonds. It's narrowed slightly. That's going to start moving out again.
Yeah, I mean, of course, you've also got political uncertainty there. It's a very difficult political climate, and that, of course, does feed into the bond market. Maybe not always as fast and directly as interest rate decisions, but it very much does impact sentiment. I think seeing that downgrade isn't overly surprising in the context of weak manufacturing, political uncertainty, and lackluster demand through France.
Yeah, as you clearly mentioned, the S&P downgrade wasn't scheduled until, the decision wasn't scheduled until I think a month later. So this was an ad hoc downgrade they decided to do last week. And these 2 of the 3 largest agencies that have downgraded France recently, with Moody's expected to take a decision next month. So, budget deficits are very big concern in France. The EU has a policy of 3% deficit to GDP, and France running about 4.6, 4.7. And the current budget, the plans right now, they don't seem that they're going to have anything fiscally responsible until 2029, which I think that's when they disclose they expect the deficit to be around 3%. And on the other hand, you have the parliament that the current prime minister has less seats than the far right and the far left combined. So the question is whether we would see maybe another government collapse, and that would increase the odds of other credit agencies, downgrading France. And the question is who's going to invest?
Yeah, the trade to me here is selling Eurodollar. So we spoke about this a couple of weeks ago, and it's been trending down since. The last year, everyone's wanted to sell the US dollar, but now the euro, the US, the overnight index swaps pricing 116 basis points of cuts over the next year. Eurozone's just pricing 19.
Yeah,
but
this has
it's
come
the euro
up,
that is so weak.
This has come up significantly. I remember with James, we were highlighting 2 or 3 weeks ago, it was just 7 or 8 basis points. So now it's 19. It's, people are concerned with France specifically. Germany is not doing particularly good either. So there needs to be some boost in consumption.
Yeah, it's not just the interest rates differentials that move the currency, it's the political stability or instability. Yeah. So to me, the trade there is continue to sell Eurodollar.
Yeah.
On to gold. Gold continues its uptrend, but volatility is suddenly spiking. You can see there the clear breakout on the chart from 3,450. But what we saw on Friday was quite a large sell-off. I said 1.8%. But if you look at silver was over 4% sell-off on Friday. Platinum was 9.5%. In fact, it's down. Platinum was down another 1% today. So the precious metal rally, well, everyone's getting involved now. But as volatility spikes, it gets that much harder to trade.
Yeah, I think with gold, it was interesting to see that it managed to clear the $4,000 hurdle relatively easily, which is no more significant than a nice round number, but it was it settled above that, broke up to 4,300, and Friday seemed to be it came off quite dramatically, along with a lot of other asset classes as well. And so my theory, though, with gold and precious metals overall was that was probably a bit of a liquidation against other assets. perhaps as some people were margin called as S&P was coming off, etc. And if you were to look at palladium, for instance, I think, it's got almost like a local top around 1600, which it's struggling to get over right now. So if we'd spoken in the past about, gold obviously being the gold standard of these metals ETFs and these buckets, but when you have a lot of other sort of metals within the basket in standard ETFs, including silver, platinum, palladium, they all have their internal sort of sticky points that they might struggle to get over. So when you see things like palladium struggling to get over 1600, it's going to weigh heavier on gold, and it's not just going to be a clear upline. So I think we might stick around these sort of levels with gold for a while now.
Yeah, I mean, my case is slightly different, I would say. As we're going to show later, central banks continue buying.
I've got that chart up next. Yep.
Yes. As we can see here on the next chart, central banks continue buying. It's mostly central banks from emerging markets, or let's say least developed economies. So Poland was buying a lot. China is obviously buying a lot. Kazakhstan, other central banks are heavily increasing their purchase on gold. And it seems there's no really a stopping here. You have everybody wants to catch the rally. Obviously, I don't think...
I would go against that though, because if you're a central bank, you're going to keep buying, you want to see it lower. So wouldn't you try and trigger some stops? Because there's a crowded positions now of retail in there. Yeah. I remember the SMB used to do it.
Yeah, definitely. But I think at the same time, central banks don't really want to shock the market. Obviously,
but they don't mind having a sell-off if it's the sort of retail side that's caught. It gives them a chance to get back in.
Yeah, that's a good point.
I agree. There's a stop. There's a bid below the market. Yeah. But you don't. If you're a central bank, you don't want to see it keep going up that hard.
Yeah,
that
definitely.
Quickly.
That's a good point. That's what we've seen recently. German central bank. Central bank in Germany has selling actually gold. The central bank in Singapore has also selling gold in very large quantities. So some of the big ones have already started doing that.
So also, just worth noting the sort of tradecraft behind that. A lot of people, if they want to get into a position without spooking the market or driving things higher, a lot of people employ volume-weighted average prices in order to mitigate volatility. Because if they were to be buying gold at 4,000, they'd also probably want to be buying similar quantities at 3,200 earlier, etc., etc. So what they're probably not going to be trying to do is squeeze the sort of, whether it be the physical or the financial, they're probably not going to be looking to increase volatility in what is already a volatile market. They're probably just going to want to be slowly and steadily buying at regular intervals.
Interesting.
But then, you have the funds. They keep increasing their inflows. Last week, they added over 8 billion worth of gold and silver in their positions. And it's the second biggest weekly inflow on record. The first one was the week before, which was 9.5. So you have these funds. They continue by. They have attracted over 34 billion in the last 10 weeks alone, which is record in history. Obviously, this is part of silver. We had this silver squeeze last week. Everybody was speaking about, and it was mostly people trying to, capitalize on the shortages on LME. But if funds are buying and they're buying at record levels, the question is where we're going from there.
Yeah, if we bring up the silver chart as well, silver fell 4.2% on Friday. Palladium 9.4%. You can see short-term trend, 8-day moving average is clearly still up. As you get these moves, you get more volatility. What makes me nervous about charts when they go straight up is at some point they tend to fall. It may be different this time with central banks. If you look at whether it's nickel or silver back in 2011, 2012, Baltic Dry Index or Shanghai Composite, whenever they go straight up like this, they pull back at some point.
It's quite interesting though, so silver managed to eclipse its absolute all-time high in 2011 the other day, whereas palladium is still sitting comfortably below its all-time high. It reached about $3,000, I think it was 2022. So it has historically been, basically twice the levels we're at, whereas with silver, with gold, we're at all-time highs. So from an idle investing perspective, I look at palladium and think, there's room to go on the way up here. And if it captures that upward trending momentum, it doesn't necessarily have as natural a ceiling as gold or silver might do. If people are worried about buying an all-time high, maybe they would look to palladium as a better option.
Yeah, definitely. I mean, silver, we made quite clear last week we should expect some at least minor correction coming in. You saw from COMEX, 15 million ounces were withdrawn for the week ending 16th of October. People trying to, capitalize on the physical arb and even sell vessels or even airplanes to London because of the LME squeeze. So this should come down soon, at least for silver.
It's interesting. You're talking about the facts, the fundamentals, but of course, a lot of people are just trading this simply on the price action. There's a trend, and the retail jumping on a GameStop or the latest mem stock.
Yeah, definitely. But when you have, something has to give in. When you have an exchange selling a lot to capitalize on the other opportunity, something will, at some point, we should have this parity in both exchanges.
The other thing that's interesting is that precious metals going up while asset prices and risk-on sentiment, typically they're going up when equity markets are falling. It's seen as a safe haven. So if we were to see a fall in equities at some point, and certainly seeing a bit more volatility there as well, then it'll get very interesting.
Yeah.
Move on to Brent. Brent's been selling off all week. What's going on here?
It's been an interesting case. Everybody now is really worried about this super glut we were discussing over the last few weeks. We had the IA, they came and they forecasted for Q1 and Q2 of next year an almost $5 million barrel build per day. So everybody's asking, where's demand? Is whether it's China continuing buying or they've slightly eased their pace. And that's been reflected in Brent spreads right now. We see only the first two spreads are being in backwardation, and the prompt one is around 14 cents right now. This, I've personally never seen that low. And after the two prompt spreads, everything else is in a contango. So that highlights that markets expect supply to exceed the demand levels heading into March. So it's an interesting case.
Yeah, I think the sort of mainstream media narratives have very much been that there is oversupply and, as you said, the super glut. I've never seen so much media consensus on floating storage being full and all of these things, which to me is a bit of a warning sign. When all of the media is spouting one narrative, either it's truth or there's some big big game being played. But that's the consensus as to why, as to sort of the supply and demand dynamics of Brent going forward. And as a result, there's been a big sell-off. And yeah, the lack of Chinese demand is probably going to be the other, the big thing that moves here. Anecdotally, I think we've seen Chinese funds easing on their buying on Brent, which, if historically China has been a serious buyer and puller of barrels from the Middle East, but also North Sea, etc. If they're going to be producing less and consuming less, then that's going to be, ridiculously detrimental to flat price.
Yeah, definitely. We need to see how this is going to play, especially with imports from Saudi. In December, we should expect Saudi to significantly reduce the official selling prices. They sell the crude to Asia. But an interesting story last week was China was buying a lot of heavy crude from Canada, which had put some pressures in the storage levels in Oklahoma for WTI in Cushing. So we need to see how this is going to play. So it was a record buying. I think from memory about 70% of Canadian barrels were heading into China. So there seems to be demand there for now.
Another key point, if you look at the chart as well, is the market's traditionally long. Speculate. We highlighted last month, WTI speculators were net short the first time ever. If the market's wrong, where do you have your stop? And you can see the clear double bottom support here. This is dated Brent, targeting right on 59.37. Similar to the 2-year yield that we looked at. It's right on support. If it breaks below, then stops will get triggered. And those that want to get short will use that as an entry. So it's a fairly key risk level at this point.
Yeah, it's an interesting sort of game to play this as well, looking at the Brent chart and looking at the outright dollars, because, futures, you see around that $60 per barrel mark, it seems to constantly manage to find resistance. It does break it, but over the longer run, it seems to find a floor there. But of course, when you look in the longer run, whilst this floor seems to be there, inflation adjusted, this is incredibly cheap Brent compared to prices over the past pretty much 30 years. We're in a very cheap inflation-adjusted Brent environment. So you would have thought if, there's genuine demand for it and it's cheap, that there would be more and more support at these levels, and you might expect, a natural skew to the upside, because it's part of the inflation dynamic. It's part of consumption. Like, everyone uses oil for all sorts of things. However, we see it kind of flatlining on this, genuine outright $60 per barrel level.
Yeah, but this is future, so we also have to take into consideration, the physical, the logistical side, which is to deliver the crude. And it's particularly interesting to highlight, since China imposed those port fees to US ships, VLCC rates have skyrocketed. I think I saw last week it was around 10 million for a round trip from the US to China. VLCC rates remain pretty strong from memory, even this week and last week. So, it's not only what we see on the futures market, but we have also to take into consideration storage costs and physical transportation costs will come in play.
Interesting. And if we move on to equities, record inflows into US tech stocks while hedge funds continue selling. So if you drill down on this, global asset managers' cash allocation has fallen to 3.8% in October. That's their lowest level in 12 years, so they're record long of equities. Net inflows into single stocks last week, 4.1 billion, the fifth highest week since 2008. The largest record inflows into tech stocks, but at the same time, hedge funds have posted their fifth consecutive weekly sale of stocks.
Yeah.
How do you explain that? Asset managers getting longer, retail getting longer, but hedge funds 5 weeks of consecutive selling.
I mean, I personally wouldn't touch stocks right now. It's been the key theme. Market's been trending higher, but the question is whether this can be maintained for long. My thesis personally is that we see this being somewhat. It's obviously tech driven right now, and the question is whether we continue that trend. To me, it seems valuations seem a bit high, especially for AI stocks, and other stocks tend to follow just because there's this AI boom. And on the other hand, you have with Fed doing their monetary easing, markets are like, okay, this makes equity valuations stronger, which should in theory boost stocks. But if it's the market that's pricing a recession or some recession fears, let's say, this shouldn't be positive for stocks. So yeah.
I mean, one thing I'd say is asset managers mandated, many of them are mandated, they have to be long equities.
Yeah.
They have to have a certain amount allocated to equities. Retail tends to just follow the trend and be long until they're caught. Hedge funds tend to be more dynamic. So I tend to think that's more of the smarter money, but the trend's still going higher.
Relatively, to dumb it down, it seems to be a case of smart money selling, dumb money buying, but the dumb money is in the money. But yeah, I think it's as simple as that in my mind. But, if you're a hedge fund and you're putting short positions on, equities as a whole, or, if you're looking at specific tech stocks, like I like that as a trade, but you're losing money on that. So what do? Maybe buy gold. But yeah, it's asset managers buying, I don't see that as a particularly significant sway. Like they, as you say, are mandated to. That's kind of what their job is. They have to select the correct equities and match a risk profile, etc. But it's not hugely significant to my mind.
Yep. I'd say looking at the next chart, the NASDAQ 100, you can see where we had an aggressive sell-off a couple of weeks ago. That now becomes a key support, 24,200, just a fraction above. If that support line breaks, then you'll suddenly see aggressive liquidation. Not only because longs will look to unwind, but because that's a trigger point where shorts can actually go short and the market's in a short-term downtrend, and they'll be triggering stops as they go. So that becomes a key level. And if we look at some recent data from Goldman Sachs as well, this time of year actually is the strongest. November's typically the strongest month for buying equities, or the strongest month of returns. December normally the third strongest. So actually going to year end is historically a good time to be long.
Yeah. And James mentioned, retail is buying, and retail right now has about a third of their allocation to US stocks. So To me, it seems like we'll probably be continued trading slightly higher. As you mentioned, it's also December Q4 tends to be a good quarter for stocks. But I'm on the cautious side.
Yep. If I go on to the next chart as well, you can see equity valuations here. So margin debt has jumped actually, so it's now record levels. But you can see here the Nasdaq 100 just at the complete upper range of its 20-year distribution. It's expensive, but again, these stories take time to play out. Equities don't suddenly go down overnight, and it's there's a key level there. We saw a 24,200 level. Yeah, but it takes time to play out. And if you're going to have a constant bid into year end, then it might be a first quarter next year story.
Yeah, the one thing I slightly worry about is because so much of this in historic terms seems to be so skewed and you see price to earnings ratios so blown out, I do worry that people will look at this as, when something goes, I think it's not going to be a soft landing if the equity story does sort of dissipate, whether it be Q1 or any time in 2026. So I worry that we probably would see quite a dramatic dump overnight, especially as people, we're in a very high debt environment, and as people get margin called on that debt, if positions start going against them, I feel like it could be a bit of a flash. So yeah, that would be just the one thing that I would note.
The interesting point there with the COT data, we can see that during the COVID sell-off, was it about 20, just over 20%, retail traders, they didn't liquidate their positions. So to see a mass liquidation, you have to go all the way back to financial crisis, which is, you were pretty young then.
Yeah, I was in the age to invest at that time. Yeah.
Well, here, Warren Buffett's portfolio, his latest filings, his main positions, Apple, American Express, Bank of America, and Coca-Cola. Well, the other famous investor, Nancy Pelosi, what's she long of? NVIDIA, AYGO, which is a semiconductor infrastructure software company, Google, and the other one, BST, power generation company. Her net worth, something like $270 million, which is pretty incredible for someone in public office.
Yeah, to my mind, interesting about Buffett's portfolio there, that obviously, he liquidated a lot of his equity positions about 6 to 12 months ago, has a lot of cash, and the largest company that he owns, Apple, also had a lot of cash. So I think he's very much in the cash is king sort of mentality.
Yeah.
So in that case, where do we invest right now? October 2025, you could buy US Treasuries, but the government owes $38 trillion. Corporate bonds, but their spreads are at 20-year lows. Would you buy stocks, but they have a 40 times cyclically adjusted PE ratio? Or would you buy precious metals that are going straight up?
I like buying precious metals, but I also like this idea of slowly scaling in and getting, volume weighted average fill. As a retail investor, you can look at it and say, well, get me on one of these dealing platforms and I will essentially look to pay myself in another currency other than whether it be pounds, whether it be dollars. So the two things I would look to sort of pay myself in are gold or maybe Swiss franc. And as a result, you can put that as a speculative position and say, yeah, I'm trading that and I'm buying gold or I'm buying silver, buying palladium. But ultimately, holding all of your money in another currency anyway, the currency that you're getting paid in, is implicitly a speculative position if you're taking inaction. So yeah, that's my perspective on things.
For me, I think I see a bit of a clearer path in bonds. US were pricing cuts in my mind from January. I was thinking about 3 cuts for 2025. So I would personally buy 2-year bonds and sell 10-year, just because inflation expectations should not come down. I see inflation to be around 3.5% for the time being. So, which is obviously adds, puts upward pressure to the 10-year yield because it tends to be more impacted on inflation expectations. So, I think that's a good hedge as well at the same time, just to make sure you're not too much impacted by any fluctuations in the bond market.
Yeah, the other point I like with the bonds there is the US government may owe $38 trillion, but that more impacts the very long end. So you're not going to buy 30 years. What I like about the 2 years is if they've got to cut, they've got to cut. So to me, that implies the curve will be steepening as well when we start to see if we start to see the equity risks increasing. And I like the Swiss idea as well, Swiss francs. We have earnings this week. You can see plenty of earnings coming out. Q1's really, I guess, a Netflix on Tuesday and Tesla on Wednesday. Palantir, the next slide. Interesting double top level there, a consolidation. The market's going sideways. The clear trend, trade the breakout. If it goes higher, if it breaks out, what the famous turtle traders use, Darvas amongst others, really common strategy. It's a simple stop loss just below. But the other point is you can short this here with a stop loss just above the critical resistance line in case a double top is in place and equities go down. The key point is this one's struggling to go high now. Dollar yen. A chart we've highlighted again many times. You can see clearly how the currency, dollar yen, the orange line is completely broken down, the correlation with the interest rate differentials here. Japan pricing in 49 basis points of hikes, the OAS. So central bank's expected to hike, but the currency is not benefiting from it. Of course, huge amounts of debt.
Yeah, we're talking about Japan right now. Debt to GDP is 250%, and everybody is concerned about the long end of the government bonds in Japan. Everything points to be less fiscally responsible, but at the same time, even though the central bank is expected to hike, in my opinion, there's no really a reason to hike. The consumers are not that strong. They tend to be very inflation concerned, where there's, relative to other countries in the world, there's not that much inflation. And clearly this correlation has completely broken because the fundamentals about the Japanese economy are not there. Industrial production is not doing good, consumers are not doing good, unemployment rate, there's a big concern about less people being employed. Japan has as everybody knows, an aging population. So there needs to be something, a bigger shift. Interest rates do not seem to be the best option for me right now. As you mentioned, James, Japan is migration. Japan needs some sort of boost that they do not have domestically right now. So yeah.
Yep, interesting. And Argentina, tell us about that.
Yeah, another lifeline boost from the US. They announced they would invest another $20 billion to Argentina, making the total investment to 40 billion. Now, this is something you shouldn't see from a treasury doing to another country. This kind of intervention. Obviously, we see.
Why is it happening? Because we've seen so much progress under Milei.
Yeah, there was progress, but he lost some elections in Buenos Aires, and he has his mid-term elections, I think, coming in the next month in November. So he lost those elections. There's growing concern in the Argentinians right now. There was this, talks that the government was doing good. They were doing better. Inflation is down, but he doesn't seem to have won this confidence from his own government.
My take on things is, number one, the reason why the US are giving money to Argentina is not because of, a great investment opportunity. It's very ideologically driven and politically driven. And I think the reason why Argentina particularly, seem to be attracting some level of confidence and have a bit of stability in the currency was due to some of the pretty drastic austerity measures from Milei and his government. He wants low government intervention. He managed to finally curb some of their debt to government spending ratio, which attracts some level of confidence to outside investors if you're looking at things on the surface level. But my understanding is that quality of life is taking a bit of a hit in Argentina, which amongst other things damages demand quite a lot for domestic products. So yeah, ultimately I think a dramatic, someone who's sort of been following a very neoliberal ideal has been sort of working on that, and that's why Trump and his posse are keen to invest. But it's not necessarily just because they've had a better set of financials doesn't really reflect an improvement in the Argentine economy, I wouldn't have said.
So what do you think about the peso, James?
I think speculating on the peso is absurd because, you know, you have two rates, one on the street and one at the FX place. So yeah, I wouldn't be getting long, but I also probably wouldn't be getting short because it just seems to be, you know, a highly volatile and also a bit of a fake economy.
Yeah.
I wouldn't be entirely surprised if, you know, within 10 years or so, they just abandon it and try and move to some either unified South American currency or just go to the dollar, or do what some of the, you know, places are turning to cryptocurrency in some of the Latin American countries. So yeah, I wouldn't like to get long, but also if I were to get short in the long run, maybe your entire position would be labeled null and void if the peso doesn't exist in a while.
Yeah, definitely. I'm not that confident in the peso either right now. I think we might see some correction like this chart break higher, so dollar gets slightly stronger relative to the peso.
Tough currency to trade.
Yeah.
Talking of which, let's move on to Bitcoin. Here you can see what's known as a megaphone pattern at the top. It's getting higher highs and lower lows, more volatility. It makes it incredibly hard to trade. Unless you mean reverting, you're just getting whipped to.
Yeah, it'd be very interesting to see what happens if it does sort of settle below $100,000 again. I don't know, the consensus on crypto from what I see still seems to be relatively bullish overall, as in bullish the sort of entire spectrum. But Bitcoin, just such a volatile asset, I don't like it.
Yeah, I totally agree. But when you have banks announcing they are going to trade it and put it as an asset class for their clients, that's going to bring a lot more liquidity into the system and maybe some slightly less volatility, because banks don't really like to do volatility plays. They want to have something slightly more secure and slightly something that can provide market to their clients, as obviously, you know, James. So I don't, you know, there seems to be volatile, but there's some institutional client interest right now.
Yeah. What amazed me, I was speaking at a conference a couple of 2-3 weeks ago, global investment conference in Dubai. Crypto came up. It was half a day spent on it. And what amazed me, the amount of people that still think it's worth zero and the amount of people that still think it's going above 250,000 and going to the moon. Complete extremes still in the market.
Yeah, I find this idea of, you know, the cryptosphere and blockchains is quite an interesting thing, and it has legs. And also I think you're going to get big institutional players wanting to play ball with that. You know, BlackRock, they want tokenized investment so that someone who wouldn't necessarily be able to put $1,000, you know, a retail buyer who wouldn't be able to put $1,000 in, is able to put $10 in and start to accumulate the BlackRock sort of ETF style thing on blockchain. It liberalizes investments, it makes them cheaper, and fundamentally
Faster settlement as well.
Exactly. So I think that as an idea has legs, and I don't see any reason why that wouldn't be the sort of the shape of future investments. However, Bitcoin itself, just to me, it makes no sense. So yeah, I'd be more crypto worth something, Bitcoin worth zero would be my sort of.
Yeah, I'm a bigger fan of Ethereum, the platform, what's settled on it, but
it all follows off of Bitcoin.
Yeah, Bitcoin's the standard. Other news, Korean stocks are set for their biggest year of the century. Currently, the market is up 56% year to date. And the Indian rupee, another Asia's worst performing currency, heading for its biggest annual drop since 2022, especially tough when 90% of its imports 90% of its crude.
Yeah, it's going to be quite captured, especially with a weak currency.
Yeah, weak currency and, you know, all these tariffs that Trump keeps, you know, threatening about India. He doesn't do the same with China. He only does that with India. So we need to see how this continues playing. He seems to be quite robust, and he doesn't really change his mind on India. So this 50% has remained here for long.
Yeah, it's amazing how quick his tariffs last week, his threats to China got nullified when China started talking about rare earths.
Yeah.
I was talking with one of our traders here at Onyx, and the sort of fact of the week that we were coming up with is, if you go on Polymarket and bet against Trump actually implementing any of his changes every single time, you outperform the S&P this year. So, you know, Trump always chickens out, I suppose, is the moral of the story.
On to the OIS pricing, we mentioned already 116 basis points of cuts priced over the next year by the Fed, or by the market. ECB just 19. We had weak employment data out of the UK last week. The market's pricing 2 cuts, Bank of England. But there, rates in a year's time, 3.46%, the market's pricing. Euro rates 1.74. So I think, in my view, actually, I'd expect more cuts from the Bank of England. And certainly, especially when you've got some of this amount priced in by the Fed. So I think we may have seen the lows in the dollar for now, and dollar strength, cable weakness, euro dollar weakness as well.
Yeah, just on inflation, I mean, we can talk about it next week because it seems to be a downward trend, but agriculturals, potatoes and corn and wheat, prices have been pretty, steadily falling. And we're sort of back to 2021 parity, pre-Russia-Ukraine crisis, which led to various spikes because of supply chain issues. So this does feed into the narrative somewhat that, both the Fed and Bank of England were saying, which was that some of the inflation that was being caused by foodstuffs inflation was more temporary. So yeah, I think, people are probably going to be, it seems as though inflation is going to be less sticky from a food perspective, and that would encourage rate cuts ultimately.
Also, if you look at crude as well, Ben, not just for transportation, but also for packaging and everything that's used for.
Yeah,
that's going to have a disinflationary impact on the market as well. So what data have you got the week ahead?
So Monday we have, today, current account in the euro area and construction output, as well as Canadian PPI figures. Then on Tuesday, infrastructure output in India, as well with Canadian CPI, and we have Fed Waller speaking as well tomorrow, which is particularly important given the considerations from Trump administration. Then on Wednesday, UK inflation. Let's see how this plays. It's particularly important for the Bank of England, as well as Japanese trade data, which seems to be taking a real hit recently with the tariffs from the US.
Friday, CPI is apparently coming out.
Hopefully, let's see.
We'll see. So what's your key take for the week? For me, it's the 2-year yield. If it breaks consistently holds below 3.45, then I think we see another leg lower in yields.
My key takeaway from the week is keep scaling into metals, but don't necessarily. I think we'll see some tops here for a while, and we're not going to be breaking out higher for a little bit. So yet again, if you have a bullish belief, this is probably a decent time to load up.
Yeah, I think I'm more focused in the euro area, France, right now. They have, regarding the budget, they're going to meet on, I think, this Friday, if I'm not mistaken. So that's going to be particularly important for the second biggest consumer in the euro area. So yeah, let's see how this plays. I think the ECB might be more focused on what is happening right now in France compared to other economies. Germany seems to be slightly more, let's say, there's nothing really going on. It's apart from the auto industry that everybody's a bit concerned. So yeah, France will be the key takeaway for me.
Excellent. And one final point to finish with. Last week, I was in Malaysia doing training on AI data analytics in commodity and financial markets. We have training coming up with our new traders, which you can join, and we have some online training coming up as well. So keep an eye out for that on our company website, Flux Institute. Have a great week. We'll see you next week. Thank you very much.
Thank you.